Happy Friday and welcome back to Real Estate Mindset. Thank you for joining me. Happy to be here with you guys ending the week. I will be back on Monday to start the week out with you. And do me a favor, if you guys are watching right now live, send some comments below. I'm going to try to do a lot of sharing comments. I want to basically do a lot of Q&A. So throw up some comments. I want to share and acknowledge the really, really good comments. And I have a lot to talk to you guys about today. I'm going to really go into this a lot more when I get to the liquidity update. Everything will be chaptered, by the way, because I've been asking myself, like, how the heck is the economy still propped up? How is there still inflation? Like, where's the money coming from, right? I mean, I feel like everyone is waiting. And by the way, do you guys like my t-shirt? I wore this to Inman. I'm part of the cheer squad. Anyways, I'm a realtor. I mean, what can you expect? But you guys, I mean, do you guys ever ask yourself that? Like, how the heck is this like party still going? How is this game still being played? Where is the money coming from? How are people still spending? So I'm going to go over that today. All right. But first, let me do a few things. Les, happy Friday, brother. Stop spending your money, man. This man, if you guys see Les, I want you to tell him, rebudget, Les. I want you to rebudget. Stop going on those cruises. Mr. Watson, how are you, brother? Don't move. Nice to see you. Straight cash. Homie, exploding banks today. I hope not, man. I hope not. Good morning, Dean. Sacred. I appreciate all you guys. Good morning. Good morning. And there's my man, Johnny. You guys, here's Johnny. Okay, this is Johnny right here. He's trolling you. Don't let Johnny troll you. Johnny's on the sideline waiting. This guy is a brilliant dude. He's actually very, very intelligent. He builds houses as well. So anyways, show Johnny some love. I'm going to get started. There's my man, Wolf. Kayleen, man, it's nice to see you, brother. Really nice to see you guys. Good morning, good morning, good morning. So I'm going to start the mortgage update right now, y'all. And we're going to go in and take a look at the 10-year. We're going to take a look at the treasuries. Good morning, Jeff. Good morning, good morning, good morning. We're going to take a look at the 10-year because remember, if we really want to know what's going on with interest rates as far as like the current trajectory, not like in the future, and we'll look at CME Fed Watch on this segment, we just watch the longer end of the yields, like the 10-year portion of those yields, because that tracks residential mortgage rates, not the federal funds rate. So remember that. And think about it. The federal funds rate has not been cut yet. Mortgage rates went down 100 basis points. So again, although the federal funds rate does influence the market, it influences it. It's the 10-year. Let's take a look at where the 10-year is at right now. All right. Oh, this is my dude right here. I see your comments, Blades of Gray. Absolutely love your comments, man. I wish I could respond more to you. I don't know why, but I always get notifications when you comment, so I appreciate you. Good morning, Trish, as well. Good morning. Good morning. Good morning. Good morning. I appreciate you guys. All right, take a look, guys. Here's the 10-year right now. So the 10-year is basically, it's a little bit sideways, but it is down this morning. It is down only about 2 basis points. Obviously, we want this at 4. But my question, guys, is like, I'm seeing a little bit of a tick up. I don't even know, at first, do we need rates higher than they are right now? So during this video, I want you to ask yourself this question. Are rates high enough right now? You know that we've been kind of gunning for 4%. So I've been saying, like, you guys, this was last year. As long as this remains at 4%, the market should be tight enough. And when I say tight enough, that means that less buyers, less people buying foolishly. We need people to stop buying. We need more inventory, and we need price discovery to happen. Now, remember, you guys, metro area versus metro area, a lot different, right? And even in the same metro area, subdivision versus subdivision, much different. Don't forget that. Okay, so just because you see crazy things happening in Austin doesn't mean it's happening everywhere in Austin. And just because Anaheim is like doing so well doesn't mean there's not great deals. So it's really a matter of like your empowerment. What do you understand, right? I'm telling you guys because it's your decision to purchase. Take a look at the shorter end, you guys. So that's the 10-year. That's up 2 basis points. Really crazy moves from the 2-year. The 2-year just went negative. This sucker was actually up all morning, and it was up, I think, 4 to 5 basis points. I can't believe it's down right now. That's crazy. But anyways, that's the shorter end of the yield. This is kind of like the liquidity zapper right here. A lot of people are buying like the shorter end of the yields. But let me show you what it's doing to mortgage rates, you guys, right now. So mortgage rates are sitting at 7.16%. So we are in the sevens. Now, I think that, honestly, guys, so far, I don't know whether or not these rates are high enough to stop spring home buying season. We are knocking on the door of spring home buying season. The next few weeks, you guys, are vital. the sentiment change. Okay, so we need rates to stay high, and we need the sentiment of consumers to say, okay, I'm not gonna obsess buying a house right now. I'm not gonna obsess buying a house right now. So hopefully the 7.16% does that. But it has been a steady increase, you guys, since about the about the end of last year. So we kind of hit a bottom around the end of last year, around my birthday, and then boom, just kind of straight up. And the reason this is straight up like this, oh, okay, I still have some comments there. Oh my God, I'm so sorry. But anyways, the reason why it's going straight up like this is because inflation's back. Right. And then again, I asked, like, well, how's their inflation back? Where's the money coming from? There's so many people that are struggling. I mean, the house market's in the absolute gutter. Transactions are crashing. I mean, holy smokes, but we're at 7.14%. Now, if you guys want to buy a house right now and you want to take that 7.14%, whatever, but let me just explain to you how much money we actually pay back in interest, because I hear people get bullied all the time. If you rent, you're a loser. That's what people say. I'm renting. I'm not a loser. I'm increasing my purchasing power. I took my down payment. I get hundreds of dollars every month because I'm investing in T-bills. And I know that, first of all, I don't like to rent. I don't want to rent. I want to buy a house desperately. And I'm going to show you guys a house that I found. I actually threw it up in the Discord group this morning. It's a foreclosure. So I have found a foreclosure in Kingwood. I'll show you guys that in a minute. But look at this, guys, just to put this in perspective, okay? Because I want, whether you agree with my opinion or not, that's fine. But I want you guys to understand how bad a 30-year mortgage can be. It can be bad, right? At least it's fixed, unlike Canada and Europe and the UK, right? But you guys, here's the thing, okay? If you pay this loan for 30 years at a 7.16%, I put a loan amount of $324,000, you guys pay back $464,000 in interest. And that's why I keep saying, hey, now's a good time to like pump the brakes, figure out what you want to do, because $464,000 in interest is a lot of money in interest because the loan amount is only $324,000. Now, likewise, remember, it's front loaded with interest. So if you guys start paying the principal down within the first 5 years, especially, you make a profound difference. For example, if you guys put down about $18,500, right? So say like the first day you get your mortgage, you put down an extra $18,500, you guys save 5 years and over $120,000 on interest. Plus, you guys can make extra payments. You guys already know that. Like if I wanted to make extra monthly payments, save $1,000, I'm not doing that. I'm just saying hypothetically, if I want to make extra payments of $1,000, that would turn the loan into a 13-year loan. So that would save 17 years. So if you guys, my point, and then you would save $289,000 in interest. I mean, these are big number savings. I'm talking to you guys about big number savings. We're not going to the grocery store saving money on milk. We're saving $289,000 out of your and your family's bank account. Okay. So my point is, just come here. I want you guys to play with this. All right. That's really what I'm trying to say. Now, remember this. Okay. Now I want you guys to stop saying interest rates just for the sake of these videos, because this is our empowerment video. This is where we're all going to learn. And I will start bringing up comments when I start playing the videos. I'm sorry, but keep commenting, you guys. Remember what this is. So instead of talking about interest rates, we talk about, what is it? Can you guys comment below? Anyone gets this right, I'm going to be so proud of you. But comment below. It's not about rates. What is it about? I've been telling you guys about this. This is so important if you guys want to start like getting ahead of professionals. If you're a consumer, you want to lock an interest rate, you want to figure out what interest rates are on the consumer level, what do you look for? That's right, Eddie. My man, Eddie. There he is. Look at that. Good job, guys. Good job. That's right. That's right, Les. That's right. See, Les be going on cruises. Les, you be spending your money like crazy right now, but you're learning, and that's good enough for me. Look at this. Everyone gets it. No, not home price, mortgage price, the rate price. That's right. It's called pricing. Very good, guys. It's not the purchase price. It's the pricing of the interest rate. Remember, it's the pricing that changes every single day, not the interest rates. Okay, because look at this. Now, this is a hypothetical interest rate sheet that you guys are looking at, okay? And you guys see what I'm saying? I can still get people a 3.5. Did you know that? I've been telling you guys that all year. I can still lock in a 3.5%. But the cost to do that is 4 points. So if your purchase price is $400,000, 4 points is what? That's $16,000. So I can get a 3.5%, but that would hypothetically cost me $16,000 because it's not the rate that's changing. It is your pricing, remember. And remember what par is, guys. Par is where you get the rate for free. So when we look at this, okay, I want you guys to figure out how to read this. So when you are shopping, Christy, don't move. Jeff, Jeff doesn't need a mortgage. Good morning, Jeff. It's nice to see you, brother. This is my dude right here. By the way, where's Vital Signs? I don't know where Vital Signs is. But anyways, I want you guys to ask your loan officer for a copy of your rate sheet like this before you lock your rate. So just remember that whether you're going to buy, a year from now or 2 years from now, before you lock in your rate, ask your loan officer for this pricing sheet so you can see behind the screen. You need to see behind the screen because they can play games. So looking at this is what I want to first say. Okay, so basically the free interest rate here is the 4.25. Okay, you're almost at par at 4.125. You're almost at par, but there is a slight cost of a 1/4 point. Do you see that? So 4.125 is a slight cost. What does that mean, guys? That means, oh my gosh, Johnny, that hit my soul. That was funny. Oh my God. Johnny's good, man. Johnny's good. Johnny is good. That was good. That hit me hard, Johnny. That hit me hard right there in the soul. Anyways, I completely lost my train of thought. That was so good. But anyways, guys, remember, so that's basically your par pricing right here. Now, I have the option as a consumer to either take an interest rate based on a discount or based on a rebate. So I can take a higher interest rate and get a credit back towards closing. Why would that make sense? Why would you want to take a higher rate to get money back towards closing costs? Why would you want to do that? The only real reason why that makes sense is if you don't barely have enough money. So if you're overextended purchasing a house, which you shouldn't be purchasing a house at all, but if you are, you can draw additional funds to close by taking a higher interest rate. That's called a rebate. So if I wanted to take a 4.875, okay, so if I wanted to take this interest rate right here, look at the rebate that I would get. So I would get back 3.298%. Hypothetically, there's also high cost thresholds, but I'm just saying hypothetically. So if I needed money to close for my closing costs, I get that 5.875 and the bank pays me 3.2% to take that higher interest rate. Y'all see that? And likewise, if I wanted this low interest rate of 3.625, I would need to pay 2.9. When you see this in parentheses like this, there's different ways to read this, by the way, guys. But when you see this in parentheses like this, that's money you get back. That is the indication of a rebate. And also real quick, and I'm going to be hammering on this for probably a couple weeks, and then we'll move on to something else, but I really want consumers to get this. And then also the longer you lock your interest rate, the higher the cost is. Okay, so the higher the fee, the higher the price. Get it? So the higher the price. That's why everyone doesn't lock for 90 days because everyone should lock for 90 days, right? Like not everyone locks for 90 days because it costs a lot more money. The difference, look at the 3.99. Okay, so the difference between 15 days and 45 days is a 1/4 point in fees. So 1/4 point in fees to go from 15 days to 45 days. So you'll see some loan officers lock 2 weeks before closing or even 10 days before closing. To me, that's very dangerous because you're messing with someone's house. But anyways, guys, that's the mortgage pricing. That's how that works. And obviously that, these fees go to your bottom line. So your bottom line closing costs. All right, let's move on to, oh my God, I can't believe that I forgot to do my timestamp. I'm going to do a timestamp at 1:30 for our mortgage update. Okay, one more thing on our mortgage update. Let's see the direction of interest rates. All right, let's see what is the market saying? What is the market getting at right now? First of all, the market has basically priced out completely a mortgage cut in March, which is thank God. Because I'm going to tell you guys right now, absent economic turmoil, if they would have started lowering rates and cutting rates, even though it doesn't affect necessarily residential mortgage rates, it does affect expectations. It does affect sentiment. It does affect fear of missing out. So thank God. Thank God they're going to remain elevated. This is saying that there's basically no chance now. Oh my God, let me remove my picture. This is basically saying that there is no chance now of a rate cut in March. They're saying 97.5% staying elevated. Thank goodness, guys. Take a look at May. This is beautiful. This is absolutely beautiful. I've been talking and preaching and have my emotions and my heart on my shoulder all year, telling you guys we need to at least make it to May. If we don't make it to May, I'm worried. So look at this. This is the strongest indicator now. This is the strongest indicator that I have seen that there will be, listen to me, no rate cuts in May. No rate cuts in May makes the inflation go away. I don't know. That was pretty corny. That was dad humor. But anyways, guys, no rate cut in May. That's really good. Let's look at June. Okay, so June has a 67% chance of a rate cut in June. This is crazy. This is so good. I want to start crying right now. Oh my God, this is good. This is good. This is so good, you guys. This is what we want. But like, again, like if they don't go high, if they don't stay high, I think we're in trouble. Look at July. July is saying 14% chance of staying elevated. Take a look at this, guys. Since my last live, this has changed it. Just has changed it. This has changed. And sorry for my speech impediment, and dyslexia. I'm trying so hard. But anyways, here's December, you guys. This is absolutely fantastic because basically now the market is now pricing in only 3 rate cuts. Last time I was talking to you, it was pricing in 3 to 4 rate cuts. Now it's pricing in 3. So a total of 75 basis point rate cuts. That's really, really awesome. Really, really awesome to see that stuff. So we're going to go into our first video right now, y'all, and then throw up some comments after the video. I'm going to pull up some of your comments and I'm going to respond to your comments after this video. This first video is going to be very interesting. It's going to go into the interest rates. Basically, it's, let's see here. Existing home sales. So this one's going to be on existing home sales right here. He's going to talk a lot about mortgage interest rates potentially hurting the spring housing markets. And what I want you guys to ask yourself, again, listening to this, it's actually a really good video, is are the rates high enough? Okay, are the rates high enough for the spring home buying season? Because we have buyers on the sideline. We've always had buyers on the sideline. Since like the birth of humans, we've had buyers on the sideline. Absolutely everyone wants a house. So I want you guys to listen to this and then again, ask yourself whether or not are we in a tight enough market? If you guys don't mind, please let me know the audio is okay. Don't forget to throw up your comments about the video and we'll discuss it.
Next guest believes the spring selling season will be very mixed. Not terrible, not great. And he says the jump in mortgage rates back above 7% has come at an inopportune time. Joining us now is Ryan McKevney. He's managing director at Zelman & Associates. Ryan, welcome. Good to have you here. Why is this an inopportune time for rates to be moving in the direction they're moving? Is it simply because, well, you don't want that at the start of a spring buying season?
Yeah, thank you, Tyler. It's nice to be here. That's exactly the point. The movements in mortgage rates do matter a lot. I think your colleague Diana framed things nicely, which was the January existing home sale data that came out today. It was a good number. It was up from December. It was the best since August. When we look at the go forward trends, when we see what's happening real time, whether it's some of the survey work we do, whether it's the data we analyze, we have seen a bit of a slowdown in pending contracts in the month of January and into February. So while that headline for January was quite good, we do expect a bit of fading as we go into February and March. And at the end of the day, movements in mortgage rates going from 6.5 now up above 7, as you referenced, it does matter, and it's going to matter for that monthly cadence of transactions.
Because to just pinpoint it here, because the January numbers were based on closings that took place in that month on transactions that were probably initiated when mortgages had come off the boil a little bit, right?
That's exactly right. Mortgage rates hit up close to 8% in October, dropped down to about 6.5% in December. And that's when we saw the big push. We saw really nice pending home sale activity in December. That's what flowed through into the home sale number today. But again, as we moved into January and even more so in February, mortgage rates have moved back up. That has corresponded with a bit of a fading. And I would say 1 month doesn't make a trend. We do want to see that momentum building into the spring selling season. It's when the most activity happens.
Oh, no, we don't.
But at the same time, if we have mortgage rates peak out here and move lower, we do think eventually that occurs. It's very dependent on the Fed, very dependent on inflation. Our view today is existing home sales for the full year of 24 will be up a few percent from 23. So moving in the right direction, not a V-shaped snapback, at least not this year. But we likely have hit the trough in the latter part of 2023.
Are you surprised at all that prices have continued to go up, even in the face of high interest rates? I suppose the reason for that is that inventory is still relatively low. So if you don't have supply, that creates a floor under prices and maybe makes them go up. But the basic question is, you might expect with high or rising interest rates that prices would be much more restrained than they are, and they have continued to show basically pretty healthy gains.
Yeah, Tyler, I would say in 2023, one of the strongest points of upside to all of the housing metrics we forecast was in fact home prices. It is the dynamic you referenced. We've seen very low levels of transactions, but we've also seen very constrained inventory levels. So you haven't seen the large mismatch between demand relative to that supply. And that has fueled ongoing strength in pricing. As Diana mentioned, affordability is very stretched. You have to go quite a ways back to see this level of affordability in a bad way, unfortunately. But price continues to move higher. As we think about things going forward, we do see inventory slowly starting to pick up. This month, it was up 3% year over year. We think it continues to build through the year. Eventually, all the buyers out there have a bit more to choose from. We think eventually that helps lessen the rate of price growth eventually. But in the moment today, prices remain strong and continue to move up.
Are there any anomalies in the housing market region by region that you can point us to? In other words, is South Florida still blazing hot and the upper Midwest still cool, or vice versa, whatever?
I would say there are a lot of market by market differences. Even within South Florida, some areas remain hot. Some have cooled down a bit. I would say most recently, the checks we've done around the country, the areas that stood out most positive to me were on the West Coast. Seattle, very strong. The Bay Area, very strong. I actually heard a guest of yours, the CEO of Compass, make a similar point today, and that's exactly what we're seeing as well. So areas of strength for the moment appear to be shifting out to the West Coast.
Interesting. So what he's saying, guys, I found very interesting, is saying the strength is now going to the West Coast, which we see that in some areas. Anaheim had a bump. San Francisco had a bump from December to January. And that's what I'm trying to say here. What I'm hoping we saw there is, because remember, the rates were starting to go down. So I'm hoping with the reporting are the transactions that started in December and the beginning of January, because if the transactions are increasing like they are in some of these metros, because I've been watching a lot, you guys, that's bad. We don't want that. We want people to chill out and let things get back to balance. But, the thing is, do y'all think that rates are high enough? I mean, it didn't start out this year and seeming like it was high enough. And I also want to point out, one of the primary reasons for the lack of price discovery, it is the inventory. The inventory is low. And then people are like, and this is where I got a little bit off. Demand is slightly higher than the historical low inventory. So even though demand is in the dumpsters right now, so is the inventory. So those things need to change. And that's why I keep saying higher for longer, right? Let's get through this. Let's get through this obsession in America. But the thing that is really important, guys, and I'm going to throw up some comments here, is that you understand what's going on in your market. My market is so different, and I have access to MLS. You guys may not have that. I live in Texas. I have elements of like everything I'm talking about within 10 miles of my house, but other areas don't have what I have. So you got to understand what's going on. Couple comments right here from my man, Jeff M. 2020s will go down as highly inflationary. You think? Do you remember, Jeff, when he said inflation is transitory? Guess inflation wasn't transitory after all. I mean, who can we trust? I mean, is it Jerome Powell's job to lie? I don't know. It was Ben Bernanke's job to lie. Boil the frogs alive, right? Now, here's a comment from Don't Move, and this is a great point. Recession is happening everywhere. UK, Germany, China, and honestly, it has to happen in Europe first. Doesn't have to. But I mean, you guys, it's happening around the world. It just hasn't got to our door yet because of, I think, and I'm going to show you guys when I get to the liquidity, the government deficit spending. So here's the thing I want to talk about before going into a couple of these other comments. You could, if you were a bull, you can make a case right now that the economy is strong. Hear me out. Listen to my specificity. If you're a bull, but first of all, the bulls aren't doing this. But if you were a bull, you can make a point that the economy is strong because it's still doing well. We still have GDP growth, although I think those numbers are tainted. Don't get me started, but bear with me, because we have GDP growth and way higher interest rates than we did 2 years ago. So remember what I say, and I mean, it's just basic knowledge. Great economies can thrive with high interest rates, even though the rates are not even that high. So again, if the economy is still doing well, unemployment's still low, GDP is going up, then the rates are higher because we have quantitative tightening, doesn't that mean the economy is great? So why would the bulls think that we need to drop interest rates? But here's the thing. If we look even deeper into how is the economy great, a lot of that, you guys, is blown out of the water when we look at deficit spending. We look at government spending. Good economies don't need the level of deficit spending that's going on right now. And that is a huge area of where the money's coming back into the system. And we know there's money coming back into the system because we watched the M2. Anyways, let's bring up this comment real quick here. I can't wait until the elections because all this lip service won't matter and a 180 is coming. I mean, think about that. And that's the thing, you guys. I mean, whether or not you're bullish or bearish, I mean, I think like probably if you are concerned, if you're bitter, if you're scared, you know, pretty much we're going to have a complete picture. It's hard for me to say complete picture, but like after the elections. I mean, after the elections, whatever's going to happen is probably going to happen. Probably. I mean, it's just crazy. It always goes down that way, and it catches so many people off guard. So I hear you, Luke, on that one. I got something from Emily now. Yet, when you get laid off, medically disabled, homeless, and in medical debt, not easy to afford housing that is accommodating to that individual. The thing is, Emily, and this is what I'm trying to tell you, like everyone, Emily, for sure, like all of those elements that you're saying make it a lot harder to live comfortably, especially if you lost a job. But the interesting thing, Emily, is there's so many Americans right now living paycheck to paycheck. Like if 70% of people lose their job, they're going to suffer. They're going to go under. Some people are going to have a repo, bankruptcy. It's a big deal. When people lose their job, it's game over. It's game over. And I'm saying like lose your job and not be able to get a new one. Right now, there are people losing their job, but they can still get a new one. Yes, it's that DoorDash, right? It's part-time, but you can still get money. And that right there, my friends, okay, and I know the info is tainted. I know it's 3.7. I know the severance. I just did a video on this, but the GFC didn't have that. We couldn't just get a job during the GFC. We had a massive unhinged unemployment crisis during the GFC. If that happens right now, the house of cards is going to fall apart. I mean, that's why the forecasting has been so difficult. We keep avoiding the recession. So good comments, Emily. Keep your guys' comments up. We're going to go into the next part of the video. And what I'm going to do, y'all, is I want to pull up a purchase contract. I want to show you guys what a purchase contract looks like. I have to re-sign into my server, unfortunately, because it timed out. So I'm going to bring up an actual purchase. This is a Texas purchase contract. And I'm just going to briefly go over a purchase contract to purchase a house with you guys so you're like familiar. Oh, my God. So you're familiar with it. I'm having a little bit of issues though right now because I want you guys to be, again, familiar with it. What the heck is this? So someone put another property in here. That's crazy, you guys. I have another property. So I put an offer in last night for a client at a 2021 price. So I'm just going to do this. Okay. Bear with me and I'm going to show you the purchase contract. We're going to go over that kind of line by line here. Okay, again, I just have to sign back in real quick. And I think you guys are going to like it, so just talk amongst yourselves if you can. And we will knock this out. So, boom, 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 boom. Okay. So anyways, guys, I think it's really important, obviously to get a general idea of what a purchase contract looks like, don't you think? And that's why I want to bring this up for you guys. And what I'm going to do right now, guys, is I'm just going to ramble right now so I don't embarrass myself because this is not working. So what I'm going to do is maybe I should bypass. Maybe I should, you know what? This is what I'm going to do. I know what I'm going to do. I know what I'm going to do. I am going to do this. Okay, so what we're going to do is I'm going to go into our next video. And then I'm going to go back and we're going to go over a purchase contract. I just don't want you guys to sit here. I have to just load something because it timed out. But this next video, you guys, again, we're going to go into our next video right now. And then I'll go back and we'll go over a real estate update. But this video is crazy. It's from the Compass CEO. I don't like this guy. I think he's an absolute bum. I think he's a cheerleader. But listen to what this guy is having to say. But I'm going to take this over here first. And let me know that the audio is okay if you don't mind. Again, this is the Compass CEO. And then I'll be right back with you to go over that purchase contract. I just need to get this out of the way real quick. move this screen. And if you guys can, again, just let me know the audio is okay. And I'm going to set up the purchase contracts right now.
Compass co-founder and CEO is here with us at Post 9, along with our Diana Olick, senior real estate correspondent. Guys, it's great to have you. Welcome back, Robert.
Great to be here.
Spring's coming.
Spring is coming.
Is activity what you'd want to see coming into it?
What's driving activity is inventory, and we have 13% more inventory this year than last year, and it converts into sales. We have 9% more homes in contract to be sold at this point than last year. But I believe that this spring market, we will see a significant increase in inventory. We can see on the Compass platform that we have 30,000 agents, a platform we invested $1.5 billion in. This time last year, 60% of new clients working with our agents were buyers that were setting up buyer search alerts. But now 60% of new clients working with our agents are evaluating listing presentations with their agents and evaluating selling their home.
So do you expect, we mentioned the 30-year fixed, is this a blip, a momentary headwind?
Look, I would love for mortgage rates to be below 7%.
Yes.
I mean, this has been one heck of a roller coaster.
Yeah.
But you don't need 6% mortgage rates when the stock market's at an all-time high. And you have markets like the Bay Area, like Seattle. I was in Seattle earlier this week. When people are paid in their bonuses and their compensation is in stock that's at an all-time high, they can afford a home.
Diana, I'll let you jump in here.
Yeah, Robert, I was actually talking to one of your agents this morning, and she said she's thrilled that what inventory she is getting is flying off the shelf. But she says sellers are having to get more creative, doing mortgage rate buy now, offering more concessions. And we're actually seeing that nationwide in those reports on concessions. Do you think as we get into spring, that's going to dissuade some of these potential sellers that you're talking about?
Yeah, I think across the country, sellers are becoming more realistic on pricing. Given the modest buyer strike last fall when mortgage rates did hit above 8%, we saw near record level price drops. And so entering this year, I just think they're more realistic in general. And so it's a great time to be a buyer. You have more inventory and more realistic pricing.
And what about for your agents, though? You know, we've seen a lot of these lawsuits recently talking about commissions, and some agents are saying they're really worried about having to negotiate for buyer agent commissions and losing on their business side. Can you give us an update on that?
Yeah, look, I think the challenge we have as an industry is agents are almost too good at their job, in that part of their job is to hide their clients from their pain. And so does the buyer or the seller at the end of a transaction, do they remember all that the agent did for them, all the open houses, all the negotiations, how many people they showed the house to, the staging, the home preparation, how many contracts that they helped them walk through? And they don't remember those things. And so actually at Compass, we are launching this year a client portal for buyers and sellers that will record in a very beautiful, visually attractive way all that the agent does for them, so that at the end of the transaction, they can be reminded in a nice, pleasant way the value of the agent.
So you're saying that it's sort of up to the agents to tell them how much work they're doing for the sellers. Is that right? You don't think that there's any kind of dislocation between the two?
Yeah, I think the typical seller and buyer that works with their agent loves their agent, but doesn't love actually the industry overall. I think our PR as an industry can be improved. Yeah. And one of the ways to improve it is to make it more visible. And so this launch of our client portal for buyers and sellers later this year will do exactly that.
I cannot stand that guy. He was in the Inman Connect, you guys. I didn't even listen to him. The cheerleading is just too overwhelmingly cringy for me. And it is what it is. I'm going to pull up real quick the contract for you guys. But before I do that, I want to bring up some comments real quick. So the first one's from this realtor. You guys, I'm sorry if I speak loud and I speak fast. I just have so much to say and I raise my voice because I get passionate. I apologize. I mean, I guess I could be timid and weak. I mean, this is kind of emergency. I'm sorry you didn't like what you've been hearing, and I'll see you next time, hopefully. So here's from Jackson. Consider for a second all the entities needing to keep mortgages moving to get paid. Realtors, title companies, lenders, inspectors, contractors, brokers, builders. It's not about affordability. It's about sales. And Jackson has a great point. Remember, you guys, sales is worse right now than the GFC. People are not getting paid. We feel the recession in mortgage. In fact, I made a video that I probably will release this weekend on the mortgage market and the fact that we are in a heavy recession right now. What's wrong with your dog? Is it stuff? This is Sunshine right here. This is Sunshine. This is an investor dog. if you want to invest in the housing market, you have to get a small dog, small Maltese. And this is mine right here. This is Sunshine right there. Johnny got me that actually. So what's good, my guy? Been here since 2K subscribers. You still release amazing content with an increased following, waiting for the chaos like you. Love you, brother. Your sanity helps me stay sane. Here's the thing, you guys. It's not my sanity. It's my ability to deal with my craziness, I think is what you are really saying. Because I am not saying, you guys, I do not like the situation we're in right now. It really upsets me tremendously. I do not want to keep renting, but I am because it makes sense. Vegas, always appreciate you, brother. Always appreciate your support. Can I put a house on buy now, pay later? No. Well, you kind of can, but it's collateralized. The buy now, pay later loans don't have collateral attached. So how could you foreclose on something that is not, it doesn't exist? From Travis K, like your name, brother. What if the Fed is purposely letting the market get over frothy so that it does the rug pull or black swan is that much more effective? I watch too much Nobody's Special, tinfoil hat. I mean, is that really tinfoil hat? I mean, that seems like if we look back at history, Travis, I mean, it seems like that's exactly what happens every single time. Change my mind on that. I mean, seriously, it happens every single time. Okay, let's pull up a purchase contract now. Okay, we're going to go back into our real estate update. Let me put my timestamp on here. Now, I wanted to show you guys this because I want you guys to know it's not scary. A purchase contract is very, very easy. This is a Texas Real Estate Commission purchase contract. This is your normal 1 to 4 contract. Now, again, guys, remember, this is Texas. And I'm just going to quickly go through this because it's, what I want people to understand is this is it's basically bulletproof. You got to fill in a couple lines. That's all it takes. So I don't want you guys to get overwhelmed with these contracts, although it is super binding. Basically, the first line is just the parties. Second line is just the description. You can put exclusions. Like this is where you put like, hey, I want the refrigerator included, or I want you to mow the lawn, whatever. This is where you put your sales price in right here. Okay, but take a look at this. Now, this is the section where you put your earnest money and your option money. In Texas, we can pay an option money that allows us to walk away for any reason. And generally, that is when we start doing our inspections. That's called option. I don't think Maryland has that, but we have it. The deal that I sent in last night, I asked for 9 days. So I put 9 days here last night. Is generally 7. The reason I put 9 days is I have a customer that is very adamant about getting a great deal. So we want more time to inspect the property. This is where your earnest money goes right here. Your earnest money, guys, is generally 1% of the purchase price, at least in Texas. So if the purchase price is $400,000, I'm putting a $4,000 earnest money. And your earnest money is what you want to keep protected. All right. Now, this is just where you put your title information. I mean, look at this. I mean, we're almost done with the purchase contract already. This is crazy. Boom. I always put at seller's expense, like if there's a survey. So on the offer I put in last night, I had the seller paying the survey and I had the seller paying the title policy. Title policy on $4,000, a $400,000 house could be like $3,000. So that's what I did. My market is a little looser than like East Coast, so I can get away with these things for my buyers. So let me show you another thing, y'all, that I like to do. Boom. Okay. Okay, so where is it? Right here. Okay, so right here I'll put like usually I'll put $500 right here. This is for the warranty. So again, normally for my buyers, I have the seller pay a $500 warranty, home warranty, owner's title policy, and the survey. But right here, you put your closing date. I mean, look how easy this is. You put your closing date right here. I mean, this is so easy, you guys. Possession upon closing and funding, unless there's a lease back. Now, special provisions, like some people put in like seller to fix foundation, right? Or something like that. Now, and they put it in this section right here. Let me tell you the thing wrong with this. You don't ever, and this is to the agents as well, but listen to what I'm saying because you could potentially avoid being denied a loan. Okay. If you put repair language in your purchase contract, so if you have something fixed, right? Anything repaired, paint the wall, patch the hole in the wall, whatever it is. If you put repair language and you send that into your loan officer and the loan officer sends that to the underwriter sees that, they will generally make you like fix it by a certified contractor. You'll need receipts. You'll need a re-inspection. So you have to pay additional money. So my point in this is anytime I have repair language, I put it in an amendment to the contract so that I don't have to open a can of worms for my client. because again, the underwriter will doom you. So there's certain criteria people have to abide by when doing a loan, and it's a freaking pain. So again, I don't put repair language in the special provisions. I do a separate amendment to the contract. Now, here's where you get the seller pay closing costs. And now, again, remember, when I purchase a house, I ask for like basically $9,000 because I don't want to pay out of my pocket. The seller's the one that's going to cash in on the equity. So that's where I usually put it. I mean, it's that easy, guys. Just boom, $9,000. There we go. Thank you for paying my closing costs. That's it. That's how hard this is, right? And then let's see what else I can show you guys. That's pretty much it. But I mean, this stuff, y'all, is easy. Then you just put all your notices right here. But I mean, how easy is this? Seriously, guys. I mean, seriously, is it that hard to do a purchase contract? I mean, it's so easy. There's just like, you fill in the blank. So don't be scared. Now I want to show you one more thing in our real estate update real quick. Let me just switch back over here. Take a look at this. And I did a poll. Okay, this is the median sales price for new homes. This is going to come out on Monday. Okay, so Monday this is going to come out. Let me just make sure it didn't come out today. Yeah, okay, so it's going to come out on Monday. You see the last it was reported January 25th. Now, I did a poll and I asked you guys, do you think that it's going to go down or are you going to go up? Now, first of all, I want you guys to explain. Last year, from December to January, biggest drop in, I don't know, what, 2-3 years. Okay, so last year, this time of year, we had a massive drop. But remember what's been happening. We started getting lower rates since about October. So the sentiment started changing. So if this goes up, it's because of the sentiment, okay? Because this should go down. Excuse me, because of seasonality, lagging data. So I'm really interested, you guys. What do you think is going to happen? Most people think that, I think it was a 60%, 60 to 40. 40% of people thought it was going to go up. It can go up because markets have been going up in January, breaking like seasonality, which is crazy. But I think that this is going to go down. I think it's going to follow the trend it did last year with a massive drop. But again, it just depends on what's going on in people's brains. What is going on in their minds? Why are they buying? And how important is being a homeowner to them? A lot of people, it's really, really important. So again, I just thought that was important, okay? And don't worry, guys. I'm going to open MLS here as well, and we'll go into some MLS data. But let me move on to our liquidity update right now. I'm going to skip the video portion because we kind of had to listen to that video in advance. So let's talk about liquidity, okay? And let's first look at the recessionary indicator, which is the 10-year and the 2-year treasury being inverted, meaning the shorter end being yielding a higher rate than the longer. So the 2-year interest rate is higher than the 10-year. That's the inversion. Take a look. Because we're almost at 20 months inverted. I believe the record is, I think the record's 21 months. So we're almost about one more week, about a week and a half, we'll be at 20 months. We've been inverted for 19 months. We've actually been historically inverted on the 3-month and the 10-year. Right now we're at the third longest inversion of the 2 and the 10. So remember the 3-month and the 10-year, we've never had that depth of inversion, and we've never had an inversion that long. That's the 3-month and the 10-year. I'm showing you guys the 10 and the 2. Still inverted 36 basis points. This is crazy. This is telling us there's more work to be done, and they're not done with QT. Remember, when this reverts or when there's a reversion, generally that's when bad things happen. So bad things haven't happened yet. Good morning, AJ. It's nice to see you, brother. Nice to see you, Nikki, Christy. It's nice to see you guys. Wally, I see you. All right. So huge indicators of pain, economic turmoil. This is our warning. This is something that the bulls cannot get around right here. This is like the number one thing. Like, hey, we're not just doomers. We're not just selling clicks. I mean, my God, look at the inversion. This is the economic indicator of recession. This is the warning. This is it. This is it. When that line goes under that black line, it spells like, uh-oh, something bad is going to happen. But we have an election and we have all this, stimulus. I'm going to show you that in a minute. Take a look at this, guys. This is the, suspension system of our economy. This is the money that was like overprinted. This is the excess money printing. They now hold it like the too much money. It's like, money out the brim, right? This is where the money is being held. This is basically a one-day treasury. Okay. It's not a one-day treasury, but look at it like a one-day treasury. It's been staying steady. Okay, I think this is going to go away hopefully by May. People are like, it's not going to go away in May. No, it's going to be sooner. But like, you guys, it's the end of February and we've had almost no move. So I think this is going to be May. I think it's going to be a May thing. Now, this is like the suspension system. When this money goes away, we're in for some rough road ahead, right? But that's the suspension. This is one area where we're getting money. We still have money in the system, but look at this right here. Okay. Because remember, I asked myself, where the hell is the money coming from? Everyone's waiting for a crash and people are still spending. How? Look at this. This is government spending for just this year. This is just this year. Okay. This is government spending. You guys, the deficit spending right now is out of control. This is where the inflation comes from. Anytime that we print money for Ukraine, I'm not going into war. I'm just letting you know that the money for Ukraine, the money for Israel, that comes back to us. You guys know that, right? They're printing money for ourselves, but they're saying they're giving it to Ukraine political, right? But those guys are using that money to buy American products. That's adding to the inflation. The deficit spending is adding to the inflation. This is bad. They've spent $2.1 trillion this year so far. That's crazy. Look at $2.12 trillion in fiscal year 2024. That's freaking bananas. That's one of the reasons why this is propped up. Look at the deficit. Let's just look at the deficit. Oh my God. So this is just the deficit, you guys. And this, I believe this is just to this year. So deficit meaning like we're in debt. So we don't make, deficit is like we're spending more money than we're making. So we're upside down right now in our spending, 531 billion. I mean, when we have the money printers, right, and we have the world currency, I mean, who cares? Let's just get into deficit, right? Well, I care because I'm a consumer and we got to pay for this. We got to pay for this, you guys. That deficit spending is out of control right now. And that is why our economy is weak. If we didn't have this right here that you guys see, and we were thriving, and we still have these high rates, okay, yeah, the economy is great. But you can't say it's great when you have this type of deficit spending from the government. Let me know if you guys agree. Sorry for that. A little bit passionate. Okay, so here is the Treasury General account. So they still got a lot of money here. They got $785 billion. Why are we deficit spending when we have anyways? So we have 785. You see what I'm saying? We got money here. We have 785 billion here in the Treasury General account. Yet we have 531 billion we've spent in deficit. I mean, who's budgeting, you guys? Is it a bunch of children in a room just spending recklessly? Do these people not know how to balance a checkbook? Think about what I'm saying. Look at the assets held by the Fed. This is even more messed up. This is 7.5 trillion. This is total assets. Here's the, I used to call it a bank bailout right there. Okay, well, I'll hold that terminology back because of Danielle DiMartino. But the Fed still got 7.5 trillion. Okay, take a look at this, you guys. Here's one other thing I wanted to show you. This is market expectations. Remember how important emotion is. Emotion will beat fundamentals. It's crazy that works, to be honest with you. That's just how emotional we are. And I saw that super chat. I will answer that. Thank you so much. But I wanted to show you this sucker. Let me go into the 1 year. This sucker has been not skyrocketing, been going up since beginning of December. The Fed, this is the expectations. Okay, so the Fed wants this to be 2% or under. It's elevated. Okay, it's not unhinged, not yet. Okay, but it started to become. Look at this. Look at the trajectory. So this means, guys, and this is why the market is suffering. This is why the market's in pain. This means that the market really doesn't think that inflation's under control. Okay, so despite what we're hearing in the headlines, despite what we hear from these financially biased economists, the market does not think inflation's under control. We see that here. See that right there? So what the heck with the headlines? What the heck with the headlines? Just saying, you guys. Anyways, hope you guys enjoyed that. We're going to move on to our next video. And our next video is appropriately titled, it's basically inflation's still around. Inflation's very sticky. Now, who we're going to be listening to is the former Dallas Fed. Okay, so he's basically sounding the alarm like, hey, you guys, if we lower rates too soon, inflation's going to come back. Okay, which would be a sign of a strong economy if couple things, but if there wasn't so much deficit spending and if consumers could still save money and not get into debt. If you compare again, you put the CPI over Case-Shiller home value, you see that consumers back in the 70s and 80s, completely different consumer. Super strong. Right now we have weak consumers with deficit spending. That's the economy. Weak consumers with massive spending and government deficit spending. Right? You guys, you think I'm wrong here? I mean, maybe I'm wrong. Maybe you guys disagree with me. Let me do the timestamp for this video. I'm going to throw up some comments. Okay, we'll answer some comments after the video. Let me know that the audio is okay. I appreciate you guys.
It's good to have you on our program. Thank you for being here. Good to see you, Scott.
Steve perfectly summed it up. So some were concerned that inflation progress could stall. Do you share those concerns?
Yes, I do. I think if I were sitting at the Fed, I'd want to see more evidence that this inflation improvement is going to continue. And the reason that I'd be very cautious is substantial amount of fiscal spending, Inflation Reduction Act spending, Infrastructure Act, unspent ARPA money. I think while monetary policy is very restrictive, fiscal policy is very stimulative. And so I would be on guard about that if I were at the Fed.
How much more evidence is warranted before they actually make that first move to cut rates? They've already suggested that they're going to cut before inflation gets down to target anyway. What's the magic evidence or the magic number that allows Jay Powell to do that?
They're expecting continued disinflation on goods, even with the supply chain issues in the Middle East. The sector I'd be watching, and I'm sure they're watching, is the service sector, where inflation's been sticky. I don't think you need to see a lot of improvement, but you need to see the numbers heading in the right direction. And I think the fear would be you could even see a backup in inflation here in the near term. And so I don't think you need to see a lot of improvement. You just need to see the numbers not going backwards.
I feel like they almost have a conundrum, on their hands, and part of what they suggest in the minutes today. Some saw inflation risks in strong demand. The premise there being, well, if the economy remains now this strong, much stronger than we expected it to be at this point, then that could cause even higher demand, which could cause inflation to go either back up or just remain sticky. But yet inflation is clearly coming down towards target. It's a real delicate needle thread.
It is. And so getting down to the low threes was always going to be, I think, very doable. The issue is how do you get from the low threes down into the twos? And the issue for the Fed is what they don't want to do is start lowering rates and then have negative reports where they have to stop or even go backwards. But the reality is there's likely to be room to cut. But I think it's dicier when you have this size of fiscal stimulus. I don't think it's being talked about nearly enough.
You guys see what I mean about, so he's acknowledging, he's like, man, I mean, how are you going to get to 2% inflation when the government is spending like this? They're talking about the Inflation Reduction Act, but like the Inflation Reduction Act was just a name to sell to the public because that act made inflation worse.
The amount of fiscal stimulus being pumped into the economy in these major projects around the country, which are the type of stimulus you typically do post-recession, not pre-recession. And I think that's what they're dealing with.
Well, but in part because of that, you don't think we're going to have a recession. I know that soft landing seems to be the prevailing thought for many at this point. You share that?
I do. As long as, you remember, we're running deficits. Last year's deficit was over 7% of GDP. That's the kind of deficit you might see in a recession. And even in past recessions, the deficits haven't been that high. It's historically very unusual to run a deficit that high when you've got full employment. And so, yes.
You guys hear what he's saying right now? Like, this is, I hope you guys are getting it. It's so powerful. He's like, dude, like the deficit spending, they're spending like a recession is here. But the reality is they're spending like that because the recession is here and they're just propping it up. I mean, he's saying it. He's like, how do you have a recession when the government's so out of control with their spending? Y'all see my point here? And that's why the economy is weak.
I don't think you're going to see a recession. The issue is how much longer can we keep leveraging up at the fiscal level? Debt to GDP is over 100%. And so the issue is this soft landing isn't free. It comes in the cost of interest expense in the federal government heading toward $1 trillion, not this year, but next year. And I think that could turn out to be a bigger problem for us to deal with.
All right, you guys. So a couple things here. Let me get back onto this real quick. I'm going to throw some comments up here. First, starting with this: buying a house is the same as buying a car nowadays. You can't trust anyone. I'm going to disagree, Pat. It was always been like that. You can't trust anyone since the beginning of time in the housing market, and the reason is that the commission, the biasness, and there's just too much of a lack of quality agents. And that's why I keep telling you guys, when you find yourself a quality agent, an agent that's calm, that uses the data, hold on to them. They're a golden asset. Someone that could tell you don't buy, that's who you want. That's who you want as an agent. You know, not the cheerleading. Okay, so a couple things here. I want to throw up that super chat first. Sorry, I didn't talk about that last time. So this is from Jay Sid. Jay Sid, thank you for the support, brother. So he's asking, is a VA loan a better option this period? Okay, so first of all, normal disclosures, every situation is different. Every deal is different, but overall, in my opinion, when we compare a VA loan compared to USDA, FHA conventional, and if the buyer has any type of disability, I mean, I think it's the best loan out there. I think a VA loan is the best loan. It's still amortized the same way. You're still going to be, getting the bank filthy rich if you don't play with your amortization. But VA loans don't come with mortgage insurance, and that's huge. So there's no mortgage insurance on VA, and there's no down payment. You can still. I'm not saying don't necessarily not put a down payment, but I'm saying the ability to do that is there. So, like, the one disadvantage with VA is the funding fee. The funding fee, I think, is 2.65%. It's rolled into the loan, but they have that upfront fee rolled into the loan unless the veteran has a disability. If you have a disability, that fee is waived. And also, if you have 100% disability here in Texas, and I'm not saying personally, do your research. I'm not giving financial advice, but if you have 100% disability in Texas, you get to avoid all property taxes. So Texas treats their veterans well. And also, if you live in Texas, look at the Texas VA Land Board. The Texas VA Land Board has lowered interest rates for veterans. I think honestly, and if I was a seller, I'm just going to be honest, guys. If I was a seller and I had two similar offers, I would take the veteran offer before the other offer. I'm just going to be honest with you. I hate that agents talk crap on VA loans. It really frustrates me because it's just so disrespectful. All right, here's a comment from Joel. No, they don't balance. They treat our money like a no credit card that doesn't need to be paid. That's what he's talking about, the deficit spending. They're spending like children that didn't go to college, that they don't have parents. This is a comment from AJ. I am a senior software engineer and I make decent money. Why are you bragging, AJ? I'm just kidding, brother. But I would say now is not a good time for newbies. Too many layoffs and salaries are dropping. And basically what AJ is saying, like, hey, it's a tough read out there. Like, the thing is like, first of all, I've already lost my job. I've already lost my job. I've already lost my job. I walked away, but I walked away with the door open. Now the business is closed down. So I've already lost my W-2. Thank God I'm self-employed. I have multiple self-employments. And I think you guys should look into self-employment as well. But like, the moment some people lose their job, it's just game over. Done. That's what happened during the GFC. Good stuff, AJ. I got a comment right here from my man Vegas. One of two things. Two things will happen. Raise rates and tank the banks. They're already getting slaughtered right now, man, especially with commercial real estate. Commercial real estate is destroying them. Or lower rates and inflation surges back. I mean, pick your poison, but the chickens have come to roost. Something's going to happen. I don't think inflation can happen very much, Vegas, because, like, I'm telling you, man, the bottom 70% of people, they're already suffering. And look at this comment from Top Villain, guys. Look at this. I mean, he said this perfectly. Inflation Reduction Act is an oxymoron. How the hell could you reduce inflation when you just printed a whole bunch of money and you're spending it? You guys, they are duping us. They come up with these catchy taglines and they sell us on it. It should be the Inflation Increase Act, not Inflation Reduction Act. I mean, you guys, we're getting played like fools here. I'm so frustrated. Lawmakers and heads of major corporations are dumping stocks. What do they know? And this is my man, Les, right here. Les, I love you, brother. I do work. Someone got mad at me, Les, because I was giving you tough love the other day because I care about you. And they're like, Travis, I was going to love you, but you're picking on consumers. But, like, they don't realize, like, am I picking on you or do I love you? There's a difference, right? Like, if I didn't love you, Les, I'm worried about your spending. I'm just to tell you that right now, man. But he's right. And then who was it? Amazon sold 60%. Jeff sold 60% of his stock. You guys, what do you think is going to happen? They just sold 60%. Les, I think it was Google was the other one. Comment below, Les. What was the other one? I know it was Amazon. You guys, the most powerful person in the world, or one of the most powerful people in the world, one of the richest people in the world, just sold 60% of their stock. What does that tell us? What does it tell us? All right. Anyway, sorry for that. Hopefully that wasn't condescending. If it was, I'm sorry. All right. Here's a comment from Emily. And I want you to listen to what Emily is saying. Okay. Because we get wrapped up in like, yeah, let's crash. Let's get a great deal. Okay. But I want you to really listen. Uh-oh. My power just cut out. Hopefully I didn't lose my signal. Okay. I'm still good. Oh my God. Okay. So am I still good? Can you guys comment? I'm still good. I just lost my power. Okay. But I want you to listen to what Emily is saying, you guys. And I want you to show some empathy. Because she's hitting home runs here. Genuinely sick and disabled people are basically being left to rot or die. This is America. And this is going on. The horror stories I've been hearing across the country is devastating. And this is why I tell you guys, okay? Because I used to be in the gutter. I used to have overwhelming depression. I had so much depression, I couldn't even function. I just had no confidence in myself when I lost everything. This is why I tell you guys, help people. If you're bitter, if you're resentful, if you're struggling, go buy someone a coffee in line. Go tell you don't have to just go pray for someone. Literally go, if you see someone struggling, go say, hey, can I pray for you? And see what happens. You guys, we have goals. That's important. I have my goals. But if we start running over people to achieve our goals, we are no better than these institutional investors. What makes us different is in my opinion, is we won't kill and run over people just to get what we want. So remember this, when you're celebrating, when the market does start crashing, we all know this. Remember, in order for us to win, people have to get hurt. Never forget that. Okay. And again, why do you think I made that home buying course? Why do you think I did that? I walked away from probably $100,000s of dollars that I could have used right now. I'm like, oh my God, I could have used that money, right? So that I have a platform for you guys. So that I can show you guys, you see, I didn't take the money. I chose to help the people that can't afford help instead. And that's what I'm saying, you guys. That helps me. That helps me with my frustration of the situation renting right now. It helps me. And I would strongly encourage you guys to do that because as Emily is pointing out, there are people that are in need way more than you and I. So don't forget that. We're well off. We know to empower ourselves. I'm sorry, you guys probably didn't sign up for that. I'm so sorry. I didn't mean to. But I won't walk away from someone on the ground. You see what I'm saying? I'm not going to walk away from someone on the ground. Dental coverage. Why do realtors act like psychopaths? I have to put a timestamp on this real quick. Okay, so why do realtors act like they own the home that they represent? They are the bridge for the buyer, but in so many cases, realtors don't answer the possible negative questions. They really suck. The thing is, dental coverage is their job is to sell. A lot of realtors, not all, but a lot of realtors, well, first of all, they don't understand what's going on. So you have a group of realtors that just cannot comprehend what's going on. And then you have another group of realtors that is just only thinks they can be optimistic. A lot of realtors are worried that if they're honest with you or if they're discouraging with their response, you're going to walk away from them. And I constantly tell realtors, no, that's you being weak and taking advantage of the customer's emotions. You want to be honest with customers. If you're a realtor, please, you guys, be honest. But dental coverage, it's not their job. They're not trained to do what I'm telling you. I'm the only guy that I've met in Houston that's training realtors, or I used to train realtors on how to do their job the right way. No one else does what I'm saying to you guys today. It's so bad. It's so bad, dental. But there are some good realtors. Just most of them are not good realtors. I have another comment here. Our Allstate agent told me yesterday they are no longer insuring commercial real estate valued over $15 million in Houston, probably because there's a collapse in commercial real estate going on in Houston, and residential is next. Your take on insurance premium spiking in hurricane and flood risk. So the thing is, AW, insurance premiums are just going to go up when you're in these disaster areas, like in the Panhandle, right? Like West Coast Florida, Louisiana, Alabama, in Houston, Corpus Christi area, we get hit by hurricanes and we got to pay for that. So the thing is, though, is like that's going to increase premiums for sure, for all of us. But if we're to see lower premiums, like if we're going to see lower premiums go down, the prices of houses have to go down. Because remember, insurance and property taxes increases and decreases, which is very rare, decreases with your property value. All right. So remember that. So that will take some time to work through the system. Okay, so another one from John right here. I want to know what's going to happen with these people who bought a house that was over $50,000 to $100,000 over asking. they paid 20K over the asking price. They're going to be 100,000. I mean, we already know, John. I did a foreclosure video, and it was a buyer in Canada. She paid $200,000 over asking. She lost her job 7 months later, and now she's in foreclosure and has lost everything. So that's a possibility. Real quick from Vegas. Let's see here. I'm almost done. Okay, so this is from Vegas right here. Good stuff. As usual, Travis, have a couple beers this weekend. Thank you, brother. Thank you, brother Vegas. I appreciate that. Let's go back into the live comments real quick. And I just wanted to show you guys this real quick. We're going to do one more thing. Okay, I'm going to go into my MLS and we will be done. And I want to tell you guys real quick before I go into the MLS, let me just set this up. I am working on building a stronger community. So I'm working on creating another platform where we have everything there, free links, Discord, home buying courses. So I'm trying, you guys, it's been incredibly hard. I'm like a one-man army. It's been very hard to do all of this, but I am working on another platform where we have a better opportunity to be a community. Take a look at the MLS real quick. I wanted to show you guys a couple things. Okay. Now remember, I have intentionally kept you guys into the Kingwood area. Okay. I'm going to give you guys an update on the market that we've been watching for almost 2 years. Now, the first thing is I want to show you, okay, we have less inventory now than we did this time last year. That's why I was a little freaked out because again, we've been watching like this time last year, I think we had 88 and right now we have 66. So we have a lot less listings right now in Kingwood. However, the prices, let me show you. So I'll just go to results now. The prices are still low. So we have less inventory and lower prices. Let me show you guys. Oh, hold on 1 minute. Let me cancel this. So remember when I first started doing this, I'm like, you guys, we need to find something in Kingwood at $120 a square foot. You guys, look at this. I have multiple properties now that are like stupid. Look at this one right here. I showed this house to our Discord group. I'm like, you guys, I may buy this house. Okay. $104 a square foot. Let me show you this. This is crazy. Look at this house. Right now, if you guys are interested in this house, hit me up. I will rep you for this house. This house has wedge. Look at this, you guys, $104 a square foot. It's been on the market 32 days. They just did a price cut of about $18,000. Look at the condition of this house. Look at this house, man. Look at this. This is why you got to watch your market every day. It's only $104 a square foot. This is crazy. This is crazy. I can't believe this house is still on the market. That's shocking. And look at this, guys. It's a foreclosure. We already have foreclosures going on. Look at this. We have a foreclosure. What? We have a foreclosure, you guys. And it is dragging the market down. Look at, they can't even sell it. So this is going to drag that subdivision down, right? Because normally the house is selling for like $130 a square foot. It's selling for $104. So when foreclosures happen, this is what I'm saying. When foreclosures happen, doomsday. Doomsday. It's doomsday. It's going to mess up everything. But look at, let's go back to the map. I want to remind you. This, if you're a consumer, you're like, how do I monitor my market? How do I monitor my market? If you're a realtor, how do I monitor the market for my consumer? First of all, this is Kingwood. Okay, so I'm monitoring all of Kingwood, but remember the subdivision game that I am telling you, because within what you see here, you guys just see 66 comps. But what you should also be seeing is there's, I don't know, 15 subdivisions. And each of these subdivisions here are different. Okay, so even though this is Kingwood, I got to go even more local. So remember, it's about local because this is one subdivision here, Kings Mill. This is another subdivision, Kings Manor. Here's another subdivision right here. And then when I go across this road, this is another subdivision. That's very, very nice subdivision. Here's a new build community right here. Here's another new build. Basically, you guys, I have 1, 2, 3, 4 right here. I have 5 new build communities in Kingwood. And there's another one right here. I have 5. Can you, this little tiny metro, this is the problem with Houston and Texas. They got new building going on everywhere. But anyways, I'm pulling this up for you because I wanted to point out, it's very interesting. I have less inventory now than last year, but the prices are even lower. And we do have our first foreclosure. And remember, you guys, you want to go hyper local into subdivision. So you can clearly see this subdivision now. So if I want info on this foreclosure, I'm running a market analysis on this subdivision right here. But if the comp was in this subdivision, this, see, if I wanted to run it on this, then I would run a market analysis on Kings Manor because look at that is its own subdivision. Do y'all see how this works? And this is its own subdivision here. So anyways, I didn't want to talk too long there. I probably did talk too long right there. And I am sorry. Oh, I got a super chat, man. Thank you guys. From MKP2 in 2 weeks. In 2 weeks, moving into a new construction house. Is it required to pay for a home inspection? What do they even check? All right. All right. That one hurt me. That one hurt. Brother, let me explain how common this question is. This is a scary question. This question right here is common, you guys. This is, you know, a lot of people ask this. And here's the thing. It's not, first of all, it's not a requirement. An overwhelming amount of consumers believe that if they're purchasing a new house, they don't need a home inspection. And also, even if they're purchasing an existing, it's not a requirement. That's an issue. However, if you look at the testimonial, if you're watching my videos, you know that there has, especially the last 3-4 years, there's been a massive testimonial that's saying construction defects. Okay, so construction defects. And we also know that the arbitration agreement prevents so many people from being able to sue a builder if there is construction defects. So what I'm saying is, it is so important to do an inspection. In my opinion, it's so important to do a home inspection on a new build. So important. And not only a home inspection, I would get multiple inspections throughout the building process of a new home, because you cannot trust these people. A lot of times what happens, MK, is a builder is going to hire out subcontractors, and they're not even going to know who the subcontractors are. And the supervisor that's supposed to be watching them, they don't even do a good job watching them. So an inspection, I know it's expensive, but brother, there's really never a time where I would ever say do not do an inspection. You don't know what's going to happen. They may find mold, they may find so many things. So, oh my God, and you're going to move in 2 weeks? Dang, dude. So like, here's the situation, MK. Like, look at this comment, you guys. He's moving in 2 weeks. You should have done an inspection 2 months ago, brother. If you're moving in 2 weeks, even if you do an inspection right now and you found something wrong, from what I'm reading here, it seems like you're still locked in. It seems like you're still locked in. So normally what would happen, MK, is you would do inspections during the option period. The option period allows you to walk away for any reason. So from this comment scares me, man. Like, I'm not trying to scare you, MK, but yes, my God, you should do an inspection. I'm a little worried though that it's so close to that closing date. If it was me and I'm not doing personalized financial advice, I'm contacting my realtor and I'm saying, hey, what options can I do? I need to extend the closing date. But obviously you have your rate locked with the lender. There's repercussions, but I don't give a crap. You're about to spend a whole bunch of money. I'm going to do an inspection. I'm postponing. You got to know what's in your contract, man. Some contracts will not let you. Just look what's in your contract. Get with your realtor. That's not what we want to happen. Join the Discord group. Join the Discord group, for the love of God. There are people that will help hold you accountable in our Discord group. So anyways, guys, let me show you guys the Discord group real quick. Man, that comment was brutal. It happens all the time to people. So if you guys want to, become a part of the member, a member or part of the community, again, I'm going to have a different platform here in a minute, but I have all my stuff linked here on my main page at Real Estate Mindset YouTube. You can go here and you can click out any of this. If you click Discord, it's going to take you right to Discord. Okay. But also if you click this home buying class, this free home buying class. So if I click that, this is what comes up, guys. Boom. Free home buying course. Look at that. Win in a very toxic housing market. Look at that. Isn't this nice? Look at intro on purchasing power, credit, income, assets, how mortgage works, intro, payment, price, investor mindset, wedge basics, cash flow basics, what to ask a seller for. I mean, come on, guys, take it. It's free. It's not free for me. It's free for you. Take this course. I love you guys. I love the community we're making. I love it. All right, guys, I think, go to what I just showed you, brother. Discord group is just a place that we can chat after the videos. I can't participate like I'd like to, but there's just some great people in there, man. Absolutely great. Johnny's in there. If you guys want to mess with Johnny, he's in there as well. Let me see this real quick. I'm about to get out of here, but one more question from John. Travis, do banks let you waive an appraisal on a house? It depends on your automated underwriting approval. There are banks, depending on the circumstance, that will allow you. I really appreciate that super chat. That will allow you to waive the appraisal as long as there's strength in the file. So yes, banks are doing that, but not in every case. And honestly, that's probably a bad deal, because you kind of need to inspect the house. Okay. Thank you, brother, again for the super chat. Another $10 here. They are still finishing up on the house. The loan officer won't do another reappraisal until the house is completed. So can I pay a home inspection during this phase or wait? Yes, you can, because the house isn't completed. So the fact that the house isn't completed, and if there's like no walls up, yeah, do the inspection then so you can see behind the walls. Like, Wait a minute. Why didn't you use the word realtor? MK, you don't have a realtor, do you, brother? Let me know if you have a realtor or not. But oh my God, I don't think he has a realtor. That's bad. I would do the oh my God, you don't have a realtor, do you, MK? Do you have a realtor? But I would be contacting them, and I would be doing that inspection, brother. That's for sure. That is all for sure. All right, you guys, be careful with that. Take that very seriously, MK. Take that very seriously. All right. Other than that, boom, boom, boom. I think I'm going to get out of here. I appreciate you. There's Sheldon. Nice to see you, Sheldon. Thank you again, Nikki. Appreciate you as well. Appreciate all you guys. Have a fantastic weekend, Les. Yes, I have a realtor. Good, good, good. If you have a realtor, MK, you better hit them up right now and tell them what you just told me. Make sure they work for you, man. Make sure they work for you. Let everyone know where you're at. Maybe I don't know. Maybe there's someone in your area. All right, guys. Other than that, I am going to get out of here. I appreciate you guys. Don't use your emotions to buy. Use the data. Obviously, it's about local markets. Data, comps, no emotion. And love some people for the love of all that's holy. Love some people. I love you guys. I'll be back on Monday, and I should be releasing tonight a collab with Todd. I'm going to be releasing Myrtle Beach. So I have a Myrtle Beach coming to you guys, boots on the ground, Myrtle Beach. I'll probably on the weekend. They are telling me, let me this last thing from MK. They are telling me to pay a home inspection, but I also have to pay closing costs. Yeah, I know, brothers. It's not cheap buying a house, man. It's not cheap buying a house. It's not cheap. Anyways, other than that, guys, if you're out there investing in real estate, you guys already know I wish you luck, and I hope you win. Whoops, I forgot to hit end.